The last 2 years have been amazing for the stock market. 24% in 2023 and again a wonderful return in 2024 for a total growth of over 50% in just 2 years. The economy is strong, yes, and the new administration is promising tax cuts to companies. But since over a century, every 2 to 3 years on average, we get a bad year with negative returns. So it could be this year, next year, but it's gonna happen. The market historically delivers around 10% per year, not 25. Only 4 times in the last 100 years, the market delivered over 20% for 2 or more consecutive years, and this was always followed by a market crash or a strong correction. And here's the thing, market crashes aren't the end of the world. In fact, they are one of the best times to invest. Today, we are diving into 2 types of ETFs you need to know about and invest in during a market downturn. First, I'm gonna give you 4 steady, rock-solid ETFs that hold their ground when everything else feels like quicksand. And second, I'm gonna give you 3 dramatic ones that instead, during a crash, are going to drop to the ground like your phone when you're trying to take a selfie, only to bounce back even higher when the market recovers. So grab a cup of coffee or tea, because we're about to make the next market crash work for us. Our ETF number 7 in this list tracks companies that produce things that we can't live without, like food, drinks, and household products. I'm pretty sure that when the market's crashing, you're not going to stop buying toothpaste, right? The sector is called consumer staples and includes names like Costco, Procter & Gamble, Walmart, Coca-Cola, PepsiCo, all brands that always stay in demand regardless if the economy is booming or tanking. The ETF is the Vanguard Consumer Staples ETF, ticker VDC, that with an expense ratio of just 0.1% is a low-cost way to invest in stability. Plus, it pays a dividend yield of around 2%, and some steady income during volatile times is not that bad. Now, consumer staples is a good choice in a market crash because people might cut back on luxuries during tough times, but they won't stop buying toothpaste, soap, or groceries. And this is the reason why consumer staples is called a defensive sector. But now, let's talk numbers. Over the last year, VDC has delivered a 13.26% return. Its 5 years annualized return is 8.23%, and over the past 10 years, it's grown by 8.09% annually. For a defensive ETF, not bad at all. And if a crash comes and the ETF is even stable, well, that's a pretty good combination. Next up is an ETF that covers the healthcare sector, which just like consumer staples is a defensive sector that performs well during downturns. With over 36 billion in assets under management, this ETF holds some of the biggest names in the industry, like Eli Lilly, United Health Group, Johnson & Johnson, AbbVie, Merck, and Pfizer. This ETF is the Healthcare Select Sector Spider Fund, ticker XLV, that with a cheap cost of 0.09% per year gives you the best package of healthcare giants that keep making money, whether the market's up, down, or sideways. And here's the thing, no matter what's happening, people will always need medicine and treatments. This makes healthcare stocks less likely to experience the sharp declines seen in other sectors. When it comes to returns, XLV has been a steady performer. In the past year, it delivered a 13.95% return, and over the last 5 years, it's averaged an annualized return of 10%. Over the past 10 years, it's grown by 9.6% annually. Now, the result might not be as huge as the tech sector in the past 10 years, but still, it's been rock solid, steady, and it's going to overperform in a market downturn. And if you invest in the sector, maybe you'll feel a little better next time you pay a medical bill. Another type of ETF that performs well during a downturn is an ETF that reduces volatility. If you're the type of person who hates roller coasters, you're going to like this one. With 22 billion in assets under management, this ETF selects companies that have historically shown lower volatility, meaning they don't swing wildly in price. It includes companies like Walmart, Merck, Johnson & Johnson, Warren Buffett's Berkshire Hathaway, Visa, and Verizon. Steady performers that can probably help you sleep better at night when markets are falling down. The ETF is the iShares MSCI USA Minimum Volatility Factor ETF, ticker USMV. In terms of performance, although low volatility usually don't perform the best during bull markets, this ETF is giving great results. 26% return over the last year, 9.76% annualized over the past 5 years, and 10.89% annually over the last 10 years. If you had invested $10,000 in this ETF 10 years ago, you now have $26,511. Sure, it's not gonna give you the overperformance of tech when things are booming, but in a crash, I'm pretty sure this ETF is not gonna disappoint. ETF number 4, the last of the steady ETFs of this list, is one of my favorite dividend ETFs, probably my favorite. I have to include a dividend ETF in this list because First of all, they tend to be more stable during downturns. And second, even while the market's crashing, you're still getting paid dividends, kind of like getting a paycheck while everyone else is losing their jobs. And this ETF is steady, reliable, and always delivering results. I'm talking about the Schwab US Dividend Equity ETF, ticker SHD. With a cheap expense ratio of just 0.06% per year, or $6 for every $10,000 invested, SHD is packed with high-quality companies that not only pay dividends, but also have a history of growing them. SHD tracks the Dow Jones US Dividend 100 Index, and companies must have 10 consecutive years of dividend payment, a high market capitalization, high dividend growth over the past 5 years, high free cash flow to total debt, high return on equity, and expected forward yield. You're going to find names like Pfizer, AbbVie, Coca-Cola, Cisco, BlackRock, and many more businesses that know how to make money even when times are tough. Over the last year, SHD returned 27.13%. Over the last 5, 13.09% per year, and over the last 10, 11.69% per year. I don't know if you can find something wrong with this ETF. It's great, it's stable, it's defensive, and it even overperforms. If you want a dividend ETF for stability during a market crash, this is one of your best choices. Now, from now on during this video, with the next ETFs, we're going to change course completely. In fact, now we're going to list ETFs that don't perform well during a downturn. But exactly for this reason, you need to be ready to buy them because you're going to buy them cheap and they're going to outperform the market again after the crisis has passed. ETF number 3 is one of the most famous growth ETFs, with over 110 billions in assets under management. This ETF tracks the performance of the famous Russell 1000 Growth Index, which focuses on large and mid-cap US companies with strong growth characteristics. The ETF is the iShares Russell 1000 Growth ETF, ticker IWF. So why buy this ETF in a market crash? Growth stocks tend to be hammered down during downturns because investors flee to safer options like bonds or value stocks. And here's the kicker. These same growth companies are often the first to rebound when the market recovers. Think of companies like Apple, Microsoft, and Amazon, which are among the ETF's largest holdings. A crash gives you a rare chance to buy these giants at a discount. In terms of performance, IWF delivered a 37.8% return in the past year, which is more than impressive. Over the last 5 years, instead, it generated an annualized return of 19.25%, and over the last 10 years, the number stays strong with a solid 16.34%. With an expense ratio of 0.19%, IWF isn't the cheapest growth ETF out there, but it's still competitive for a fund that holds some of the best performing stocks in the whole market. It's like paying for a front row seat at a concert. You know you're overpaying, but it's worth it. And if you want to save on expenses, you can buy VONG, the Vanguard Russell 1000 Growth ETF, which instead has an expense ratio of only 0.08%. Next, we've got an ETF that covers companies that sell not essential products, or in other words, discretionary products. The sector is called consumer discretionary, and to give you an idea of which kind of companies are included in it, the main components are Amazon, Tesla, Home Depot, McDonald's, Booking, Lowe's, Starbucks, and so on. No, Starbucks coffees are not necessary. Don't start again. Anyway, this ETF is a Vanguard ETF and therefore it's cheap. With an expense ratio of just 0.1% or $10 for every $10,000 invested, it's one of the most affordable ways to gain exposure to consumer discretionary stocks. I'm talking about the Vanguard Consumer Discretionary ETF, VCR, a $7 billion ETF which can be a great choice at the late stages of a market crash because it tends to get hit hard and strongly drop in value during downturns. This is because in this phase, people cut back on non-essential spending. But here's the opportunity. Once the economy recovers, people go back to dining out, shopping, and spending on big-ticket items. That's when stocks in this sector can soar, and VCR lets you capture the recovery. When it comes to performance, VCR has been a solid performer with a 24.3% return in the past year, an annualized return of 15.9% over the last 5 years, and an impressive 13.8% annualized return over the last 10 years. And finally, our ETF number 1 covers my favorite sector, which has been the best performer in the last 10 years, but it's also going to crash the strongest as soon as we enter a bear market. I'm talking about the technology sector, which must be always your biggest focus for investing when the market is experiencing a crash, because just like this sector gets easily overvalued when the market goes well, it also loses most of its value when the market is hurting. The ETF I've chosen for you is my favorite overall in this sector, and it's a must-have in every investor's portfolio. I'm talking about the Vanguard Information Technology ETF, ticker VGT. This ETF boasts around $100 billion in assets and holds some of the biggest names in the tech world, including Apple, Nvidia, Microsoft, Broadcom, Salesforce, and Oracle. So now you need to sit down, take a deep breath, because we are talking performance and VGT is out of this world. In the last year, VGT delivered 29.24%, which is not the highest on the list, but the greatness of this ETF is its consistency. Over the last 5 years, it's averaged an annualized return of 21.45%, and over the last 10 years, it has crushed it with an annualized return of 20.75%. Now, I don't know if you can really understand what it means to make 20.75% per year for 10 years, but let me show you something. This is a tool of mine to calculate the future value of your investments. Feel free to download it for free from the link in the description below. Now, if you invest $500 per month and have an average return of 10%, which is the average return of the market, after 10 years, you're going to have around $100,000. After 20, $380,000, and after 30, $1.13 million. Now let's see what happens if you get 20.75% per year. Obviously, nobody knows how the tech sector is going to perform in the future, but humor me here, just to dream a little. With the same $500 per month, in 10 years, you're going to have $200,000, double as much as what you had with 10%, which is already great. But in 20 years, you'd have 1.74 million. And in 30 years, almost $14 million. That's 14 times more than a million you'd have with 10%. Again, it's unlikely that the tech sector will keep overperforming so strongly in the stock market because the companies themselves are not growing 20% per year. So there will be corrections here and there. Still, I don't care about corrections. They're welcome, and when a sector crashes, I'll buy more. The tech sector is going to shape the future more and more than it did so far, and while it's more volatile than some other ETFs on the list, it's a perfect pick for investors with a bit of patience and high tolerance for short-term market swings. These were the 7 ETFs that you should keep an eye on during a market crash. Some of them are stronger during a crash, so you can buy them to protect yourself, and some are instead terrible during one, and you should buy them to take advantage of the discount. I hope I could give you a good overview with this, and if I did, drop a like to this video to help me grow this channel. I wish you a great day, everyone, and as always, I'll see you in the next video. Ciao!